Hey everyone, hope you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go through Twitter, see what people are sharing. I'm going to interject my financial opinions, generally about three different topics: wealth building, commodities, and/or financial topics. So let's dive right in there. Take a look, see what people are sharing, and I'll share my financial opinions. If you want to follow me on Twitter, check out @Finance. And if you want to join our community, finding-value.com, where I dive deeper into all this stuff. I answer your questions on the weekend. We're doing a question and answer session Saturday today, 7 a.m. Mountain Time. And that's when I release these videos. There's a special going on. Special is the coupon code if you'd like to join. It's 50% off the first month only, and a larger discount on the yearly membership. And you can ask me whatever you'd like. I'm pretty open, and I try to tell you what I know. I can't share if somebody should buy something or not, but I can tell you what I'm doing. And that is basically what I am doing on the website, is showing you what I am doing and doing a lot of trainings on finding value in the markets and technical patterns and all that stuff. So Part-Time Trader says, great chart. Not looked at total like this before, so few people seeing what is about to happen. We are very likely to be in an expanded flat of some sort on the total market cap. That ends up meaning we sweep the lows. And what that means is this is for crypto total market cap, where you could potentially be in a running flat. And a lot of people, they try to size up the markets with these patterns. And what I've found is that they're not always reliable. They are good for a certain percentage of the time. Other times they don't play out as expected. That could be the classical patterns that people watch, like cup and handle patterns, inverted head and shoulders and topping head and shoulders patterns. It could be falling wedges and stuff like that. And in the short term, their probability of success is much lower. What I have found is in the long term, when you're charting big long-term cycles, and what is long-term? Long-term means that you are charting something over a 30, 40, 50, 60-year time frame and down to 5 or 10 years. Those patterns are a lot more reliable the longer time frames that you get. So what I do is I try to look for a confluence of information. What that means, it's information that merges together that says something. It makes maybe a highly probable outcome. So I look at the longer term time frames. I try to find companies that are down with exceptional value and a lot of growth over the next decade. Then I look at the long-term patterns like this one here. This is kind of a shorter-term pattern, but longer-term patterns where I buy something of great value. It is incredibly cheap, say, sector-wise. It's going to rotate in the next, say, couple of years, and it has a pretty good pattern on a longer-term time frame. Then you start diving into the shorter-term time frames for a more precise entry point. And then you try your best to get the best entry point possible, because the shorter term patterns and signals are not as clean as some of the longer terms. So if you're going to try to buy the ultimate bottom, you'll be using fractal analysis, which this is. You could be using Elliott wave, you could be using other patterns, and then basically cost average in somewhere towards that bottom. No one is perfect. When things are in real time, when you look backwards, things look very obvious. When you're going through it, it's not so obvious because you don't know exactly where C will end up. What if it doesn't end up all the way down there? What if it drops more than what C is projected? What if it goes, there's obviously Fibonacci retracements, and a lot of people say, a lot of them go 50%, 61.8. But sometimes in the smaller guys, they go all the way down to a 71% retracement. That means from the peak, you retrace 71%, and you're still in a bull market. And I know a lot of people, the Stan Weinstein, I post that. They're like, well, if you have a 30% drop, you're in a stage 4 decline. I don't know about that because in commodities, you have many 50% declines, many in a bull market. And you could say that you're making higher highs and higher lows. So are you really in a stage 4 decline, even though you're not technically meeting the 30% decline? I disagree. You are in the advanced phase. It just moves more. Amy Nixon says worse than COVID or C-19, worse than 2008. And this is U.S. pending home sales have fallen to a new all-time low. So sales are really low. We also have very low inventory, very low inventory. So that's a combination of affordability, in my opinion, that's driving this. You can't have anything else. And affordability is a fact that you just don't have any homes. And then home sales is a volume perspective. How much volume are you moving? But if you have no volume to sell, then you're just not moving much. There could be very low transactions, which is exactly the reason, which is exactly what's happening. So U.S. housing delinquencies are now higher than 2008. And he says, why is this no big deal? So then I looked into it. I said, okay, is the U.S. housing delinquencies higher than 2008? So here's the delinquency rate on single-family mortgages. So delinquency rate on single-family residential mortgages booked in domestic offices, all commercial banks. That is completely different than what this is showing. This is Freddie Mac serious delinquency rates multifamily. Oh, it's multifamily. This one here is single family. So the majority of loans in the system come from single family residential mortgages. It's over 70% of the loans that banks do in volume. So this is way down there, and it's still very low. I mean, we could be looking at something way down here. So is this a recessionary signal? No, it's not. But it doesn't mean we can't get a recession. It would be driven by something else outside of the housing market. Much like 2001, see this recession here? I think we could have something that's very similar to 2001 as a possibility. I'm not stating that we will 100% get one. So what I did is I went to Grok, good old Grok AI here. And I asked it, are we going to have a recession? This is what AI responded with. And I actually agree with it. I'm in the same category. It says predicting whether recession will hit is tricky. No one's got a crystal ball, and economists often disagree. Right now, as of late February 25, the U.S. economy showed mixed signals. Exactly. That's what I see, mixed signals. Some folks are optimistic. GDP growth was solid in 2024 with a 3.1% annualized rate in quarter three, and consumer spending's been strong. The Federal Reserve's projecting 2.1% growth for 25, which isn't screaming recession. Bankrate's latest survey pegs recession odds at a low 26%, and Goldman Sachs is at 25%, both suggesting a downturn's not the base case. The stock market's been on a tear, too, which some see as a vote of confidence. But there's a flip side. The yield curve inverted again this week. When the 10-year Treasury yield dipped below the 3-month note, a signal the Fed watches closely, with a solid track record of hinting at recessions 12 to 18 months out. Unemployment's crept up to 4.3% by mid-2024, and consumer confidence is shaky, per recent reports. JP Morgan still got a 45% chance of recession by year end of 2025, and some analysts like BCA's Peter Berezin are calling for a downturn, pointing to a cracking labor market and overvalued stocks. Posts on X echo this split. Some users see a collapse coming. Others think the Fed's got it under control. So are we headed for a recession? Maybe, maybe not. The data's not screaming yes yet. But those warning signs, like the yield curve and rising jobless claims, aren't nothing. It could hinge on big moves like Trump's tariffs plan or Fed rate cuts. For now, it's a coin toss with extra steps. What do you think? Any specific worries on your mind? I'm not worried about it necessarily, but I'm mixed. I see mixed signals in the market, and I completely agree with what it's saying. And I don't know if it would come out and say, yes, a recession's coming, but That's kind of what I'm seeing there. I wanted to read that because I wanted to try this thing out. Coming down here, it says here's another one. Delinquency rate on all loans, all commercial banks. Another one I wanted to look at. In recessionary times, this does start to come on up, and we are coming on up from very low levels. Could there be a recession? Maybe. I mean, maybe we get one like 2001, and that could very well be possible. Elon Musk writing, all government's spending is taxation. This point really needs to be hammered home. Whatever is not directly taxed is taxed in the form of inflation, as the government prints more money. Inflation is the worst tax of all, as it punishes those who are just barely making ends meet or have gathered some savings. And that's completely true. Here's the problem, though. How do you fix it? You would have to put us into a major recession, I think, to fix this. What happens is government spending is through the roof. That's called fiscal spending. They would have to reduce fiscal spending massively to get us out of this. Now, if you want to go to the direct cause, the root cause of this, the root cause is twofold, in my opinion. One, it's fiat currency. It's the ability to create a currency backed by nothing. That is ultimately the root cause. And number two is the condition of the fiat currency existing allows a lot of things in this world to exist and be taken advantage of. So what does that mean? It allows the government to run large fiscal deficits. The fiat currency does. If you block the fiat currency, they couldn't run those deficits. If you start to block all of it, like a hard gold and silver standard, then there's a lot of things that it blocks. It blocks fractional reserve lending, I believe it blocks some of that. It blocks fiscal spending deficits. It would block a lot of votes too, I think, because if you can protect the currency, it is an extension of protecting private property too. Because if you could just create more money from nothing, you are essentially stealing private property from people. You're stealing the purchasing power out of the currency, which is more or less could be devaluing some of the property that people own, if that makes sense. Because if you store your wealth in dollars, that's what it would be doing. So I think you have to block it from the way that the currency is designed. If you were to do that, you would have to eliminate the Federal Reserve like we had before 1913 because they can create money from nothing and then they charge interest on it, which then is the worst of everything. That's like another root cause. Coming out of Bravos research, mortgage payments have hit record highs, reaching 40% of average household income. This housing market is extremely unaffordable. Well, I'm going to make one observation here. Why is it unaffordable? The observation is because we have no homes to sell. And that also means that the supply-demand imbalance is skewed towards a supply shortage. If we had a supply surplus, your affordability would be better. Cycle Bottom says round tripping is everywhere in commodity microcaps, lithium, metals, copper, gold, uranium explorers. It indicates a serious incoming opportunity, folks. Less than 3% of net present value coupled with greater than 100% internal rate of returns equals high potential for 10 baggers. And this is your round trip. It also possesses the fractal that I look for on these pullbacks. I think there's a lot of great opportunities. What I would do is wait for some of this negativity to pass, get this thing to bottom and turn up, and buy into strength. That would be the most conservative approach. If you're aggressive and you want to get max returns and you can do so with maybe less money, there are strategies that you can deploy in terms of sprinkling money in at very aggressive prices, keeping your full position size kind of held back. So you put small quantities in and cost average in over a period of time. That can also work quite well. But I agree, there's a serious incoming opportunity here coming up this year. Are the home builders hurting because of high mortgage rates or because existing supply is starting to pile up? Well, it's they're hurting because of high mortgage rates, which then impacts the affordability, which then impacts your existing supply. There is demand for the homes out there, but not at this price level for the mortgage rate. So what a lot of the new home builders have done is buy down the interest rate for the affordability, and then they sell a bunch of homes. So they're already doing it. It is costing them money to do it, but that's what's going on. It's an affordability issue, in my opinion. JSG says all month over month oil growth came from offshore Gulf of Mexico. More than 200,000 barrels per day, month over month. Combined Texas and New Mexico oil production is down month over month. That's the shale production. Are we peaking? I don't know. We could be. I think we've peaked in oil, maybe not total liquids production, but oil probably. First time since 2023, the NDX has broken its uptrend. Also QQQ there that she's got, but uptrend line break to the downside. We could see a return move and a retest of the underneath this. Here's formula stocks. Silver to dramatically outperform gold until about 2060. This is the commodities super cycle, and with it, inflation reasserting itself after several decades with deflationary impulses which favored gold over silver. Tables are turning. Do not get caught up in the recency bias. And what does he have here? So this is a ratio chart, silver divided by gold. So when it goes up, silver's outperforming, and he's got this gigantic cycle. We had a huge outperformance from the 40s up into 1967, double top in 1980. The disinflationary period with lowering interest rates favored gold during this entire time frame. And the ratio pulled all the way back to the bottom here of 2020. From 2020 onward, he is basically saying that we're going to see a large outperformance of silver against gold over this next few decades. I am completely positioned for this. We could also maybe see some other metals start to change, and I might have to do some really long-term ratios to see what they look like, of maybe like platinum versus silver. Headline figures show U.S. crude oil production at 13.5 million barrels per day. But the adjustment came in negative as we expected, and it's down 319,000 barrels per day for the adjustment. So the net U.S. crude oil production is 13.172 million barrels per day. A negative adjustment is the result of overstated U.S. crude oil production. The Baker Hughes rig count, 228, looks like they added 3 rigs for gas and are down 2 for oil. Oil's just too cheap. It says, and just in case anyone is curious, U.S. crude oil production plus adjustment. December of 2023 was 13.719 million barrels per day. In 2024, it was 13.172 million barrels per day. That is a growth rate of negative 0.55 million barrels per day. We are shrinking oil production in America. Man, this is going to get fun here over the next few years. We're going to have to turn on a lot of offshore drilling, and we're going to have to turn on wherever else they can find oil. Breakaway, Freight Futures AM update. Capesize up 6%, Panamax up 1%. I know dry bulk's been ripping higher. In tankers, VLCC is flat and Suezmax is up 1%. Breaking, U.S. PCE price index year over year is actual 2.5%. Forecast was 2.5% and previous was 2.6%. We've got Grady here, and he says This is what real hyperinflation does to a stock market. That is a 23-year log chart going parabolic. It's a log chart that we're going to get to. It is imperative to understand what is happening here. Early in the move, stock market moves outweigh inflation. Later in the move, stock market gains are nowhere near the rate of inflation. Many will be fooled by stock markets going up hugely in the later stages when the time comes. The global economy seems to be severely slowing now, but stock markets are at all-time highs still. Both of those is because of fiat currency printing, leading to purchasing power destruction. Been saying for decades that periods of real high inflation starts with commodities. And I have repeated this since I called the commodities bear market low in real time back in 2020. I've also been saying since then that this will lead to stagflation. And for years, now I've been posting big picture evidence charts saying inflation is not backing down, regardless of the made up media narrative. With 30 years in the markets, it takes something extraordinary to make me sit back in my chair. And this is such a chart. It is vital to piece the puzzle together in order to understand what is coming, and in order to be prepared in detail in every way needed. This is the Argentina stock market 23-year log chart going vertical because of hyperinflation. Look at this move, 3,429% in 2.5 years. When I look at this and I look at inflation, it makes me want to take out a bunch of loans. Like that's what it makes me want to do. But obviously, I'm not going to do that. Joel Greenblatt says, you can't be a good value investor without being an independent thinker. You're seeing valuations that the market is not appreciating, and it's critical that you understand why the market isn't seeing the value. I agree with that. It's a good quote. And that's where we're going to end it there, guys. So that's what I've got for today. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you'd like. And that's all I've got for today. We do have a question and answer session, 7 a.m. Mountain Time. I'm not sure when you guys are viewing this, but that is today, Saturday. And if you miss it, it will be posted on the website if you'd like to see it later. All right, guys. I will catch you later. This is Finding Value.